Cash flow is critical. It's our lifeblood. It's what allows us to be successful financially. So in this video, we're going to look at some ways that we can improve our personal cash flow as property investors. Hi, thanks for joining me. My name's Tim. I'm a property investment advisor and a property investment educator. Now, as a property investor, what has helped me enormously to be able to maintain and sustain a property portfolio is being able to increase my personal cash flow position. So in this video, I'm going to run through some ways or options that we may have that you may not have considered. And certainly if you haven't considered them, I suggest that it would be worthwhile sitting down with your accountant just to discuss what it may look like for you. Because as I say, being able to hold a portfolio, hold on to our properties, obviously depending on our strategy, but certainly if it's a buy and hold strategy, then being able to see out the journey and make that finish line is obviously critical. That's where we're going to realise our gains. So the main reason why that doesn't happen for most investors is because the poor cash flow position. So as I say, I'm going to run through a couple of ideas that you may not have considered, and certainly again, as I mentioned, it might be worthwhile having a discussion with your accountant about. Okay, so there's two types of costs associated with acquiring a property and holding an investment property. The first one is what they call capital costs. Now, these are such things as stamp duty we pay the government on purchasing a property, the legal fees, could be also associated with initial building and pest inspections. So they're capital costs. Now, we can't claim them annually. They actually get set aside, and upon sale of that property, then those costs can offset against any capital gain. So the other costs are revenue costs. So these are the costs associated with maintaining, as I say, income-producing asset, which obviously a property investment property is. Now, those sort of revenue costs will be things like interest on the loan for that property, acquiring that investment property, the property management fees, repairs, rates, those types of things. And the ATO has an extensive list of what they look like and obviously outlines what we can claim as property investors. So I have spoken to, not many, but I have spoken to property investors who aren't aware that they can actually claim these annually against the income from them working, obviously, and also the rental income they receive. So that's one thing that we can definitely keep in mind, is that those revenue costs, again, the costs associated with maintaining that property, are able to be claimed annually or claimed as a tax deduction annually. Okay, so another cost we have associated with owning an investment property is depreciation. Now, depreciation is a on-paper loss, if you like. So it's different than a revenue cost where we actually physically have to take out money and pay for that cost. Depreciation is an on-paper cost. So the Australian government, Australian Tax Office agrees and has approved the fact that as a property investor, the value of our property is going to decrease over time. So there's two components to it. I won't go into too much detail now in this video, but there's basically the structure, and then there's the fixture and fittings of that property. But as a whole, it's agreed that the value of that property is going to decrease. Now, if we've done our homework and we've acquired a quality property, then we would like to think that the value of that property is going to increase. However, on paper, obviously, if we exaggerate a little bit, if you looked at a 100-year-old property, then there's probably a very good chance that that property needs to be replaced. Certainly, its structure, and also too internally if it was in original condition. So we're able to claim depreciation as a tax deduction. Now, to be able to do that, we need to gain a depreciation schedule, and you need to engage a quantity surveyor, and they will actually go out and visit the property most times and draw up or prepare a depreciation schedule. You can take that schedule then, and it's for 10 years, and you can take that schedule to your accountant, and then they can arrange with the tax office, obviously, then as you do your finances, they'll be able to factor that depreciation cost in, which will then again offset any tax that you may pay. Okay, so one of the other things that I become aware of after working with and speaking with property investors is how often property investors don't review their rent. So what this means is that they're effectively receiving less rent than they're entitled to. So even if it's $20 a week, it's still $20 a week, and it's better in our pocket to help with cash flow. Now, I'm not suggesting that we just keep pushing our rent up as often as we can, because you can't do that. I mean, the market will determine what it's willing to pay, and also too, obviously, there is legislation and law in each state that dictates when and how much we can increase rent. So the main thing is, though, I guess the lesson here, if you like, is that if we're working with the property manager, we should have some sort of system in place whereby we're notified as to when we can review rents, and then we ensure that that rent and the tenants are actually paying market rent. Because again, we're in this to make money. It's why we invest in property. So we just need to make sure that we're being fair to ourselves and we're putting the rent to at least market rent, so that we can maximise the returns on that property and investment property. And obviously, if we do that across multiple properties within a portfolio, it soon adds up. You've got 5 properties at $20, then obviously that's $100 a week. That's quite a substantial amount of money to most people. So making sure, again, that we're receiving market rent is something that we really should be on top of, because if you miss that opportunity to increase the rent, you've got to wait again until the next time. So again, having that conversation with the property managers just to make sure it's scheduled in these rent reviews. That way we'll keep on top of our what we're entitled to, and again, that will improve our cash flow as property investors. Okay, so what we can do as investors, we have available to us what is called a PAYG variation. So it's pay-as-you-go variation. And we really need to, well, I believe, work with an accountant to apply to the tax office with this application. And effectively what that does, if approved, is then basically our employer is notified, and our tax, or the amount of tax we pay at each pay cycle, is reduced based on those costs associated with holding that property. So rather than waiting to the end of the financial year and getting a large tax refund or a tax refund, we get that adjusted, or the tax adjusted at each pay cycle, which means we've got improves cash flow. Obviously, we've got that money in our pocket. Some people, not many, I think, as you are aware of what it can do as far as cash flow goes, because obviously you've got the ability then to use that to pay down debt, or just in general to improve cash flow, day-to-day cash flow. But it is definitely an option that we've got available to us. PAYG variation. As a self-employed person, you can possibly or potentially use this option as well. However, it works really, it needs to be sort of a fixed income and fixed expenses, because you do have to guesstimate a little bit or do an estimate of what it's going to look like over that year. And obviously with fixed costs like depreciation, other costs associated with holding that property, they are set. So you're not putting yourself at risk of overestimating. Obviously, the tax office doesn't like us overestimating in any tax deductions or what we can claim against tax. So really need to err on the side of caution and be pretty sure about what those costs are going to be that you're going to have offset against the tax you pay. And obviously, therefore, at each pay cycle, that will come down off that tax amount that you pay. So speaking with an accountant about a PAYG variation is something I really think you should do. It's worth the time sitting down just to discuss it, because again, rather than waiting to the end of the financial year, if you can get that at each pay cycle, then again, that's going to help with holding that property, paying the repayments, etc., loan repayments, just in general, holding that property. So better in our pocket than waiting till the end of the financial year. And most investors that I know use that PAYG variation if they can. Okay, so just to confirm here that basically as property investors, any dollar we spend, or each dollar we spend on directly on maintaining that property as an investment property, we're able to claim as a tax deduction. So what will happen then is, for basically each dollar, we will then receive back tax at our marginal rate. So sometimes, and I know clients and for myself, definitely what it can do is lower your tax, and sometimes it comes down to a lower tax bracket. So all these things we've spoken about today are really worth considering. At least, as I mentioned a couple of times, it really is worth sitting down with an accountant, because whenever tax is involved, you really need to sit with an accountant to discuss what that looks like for you, because everybody's different. And again, if you have a look at the ATO's website, you'll see and get much more detail about what we've covered here today. And again, part of that detail is those costs that we can claim as a tax deduction for maintaining that income-producing asset. Now, the final one I'm going to mention is interest rates. So a lot of people will fall into the trap of thinking that the rate they've got is the best rate they can get from the lender. Now, it's not true. The lenders really, that I'm aware of in my experience, is that they won't contact you to say, hey, look, we can give you a better interest rate. So often, unfortunately, it's when you threaten to leave that's when they start negotiating on rates. So I would think it's worthwhile considering chatting with you, might be once every 6 months, once a year, just having a discussion with your finance professional and just mentioning to them, get them to review your loan structure, get them to have a look to see whether there is a chance of getting or reducing your rate. And obviously by reducing your interest rate, you're going to increase cash flow. So it's a little bit of a rookie mistake to think that the lender's actually going to contact you to say, hey, look, we can actually offer you a reduced rate. One of the other things that we can do as investors, particularly if we move away from just having a vanilla type of loan, is once we start building a portfolio and we've got multiple loans, you can consider also paying, most lenders have this, you pay an annual package fee, and it could be around $400. Don't quote me on that, but check with your financial professional. And what that will do is give you automatically a reduction in the interest rate. So there'll be a discount to the standard variable rate, as an example. So interest rates, make sure, again, very similar to rent reviews, keep an eye on it. Keep in contact with your finance professional and just ensure that you're getting the cheapest rate you can get, because after all, again, across a small loan maybe doesn't matter that much, but certainly as you start acquiring property and building a portfolio and that loan amount increases, often the more debt you've got, and obviously doing business with anybody, they'll look to look after you a little bit. So the lenders are the same. The greater your debt, often they'll look at you more favourably, and those discounts are often something you can get and have approved based on the fact that you are doing a little bit more business than the average borrower. So definitely have that chat with your finance professional. Okay, well, I hope you found that information helpful and useful. And look, as investors, the majority of us adopt a buy and hold strategy. So the number one reason why property investors with a buy and hold strategy don't see it to the end is because of poor cash flow. So anything we can do to not only improve the cash flow position of a property, but also obviously our personal cash flow position, is worthwhile considering at least. So again, I hope you found the information useful, and it may even generate a discussion with your accountant. So look, thanks again for joining me in this video, and all the best with your journey.